everybody. Welcome to the Moving Markets Podcast. It is Thursday, February the 12th, 2026. Stock market has been closed for a little bit more than 30 minutes. Let's call it 35 minutes at the time I am recording this. So I know you're all watching. I know everybody that's listening to this recording is pretty well aware what happened in the market today. Things started out not too bad, kind of like yesterday. Things started out even kind of on the good side. And then not very far into the trading session, let's call it maybe an hour and a half. There's 9:30, 10:30, yeah, a little shy of an hour and a half. All three indexes just absolutely cratered, just absolutely dropped. They dropped fast and steady. It wasn't one of those, drop off the cliff kind of drops, but it was just a very steady decline over the next couple of hours. Tried to have one little rally and then finished awfully close to, if not right at the lows. At least that's where the Dow. I don't know if that's the exact session low. It's not far from it. I think the NASDAQ, it might even look a little more severe on the NASDAQ as we look at the one-day chart on there. As similar, but maybe just a little more severe on the NASDAQ. They didn't have the attempted recovery the same way the Dow did. And then the S&P 500, I think you'll see that all three of these charts, give me a second to get there. I think you'll see that all three of these charts look awfully similar. And this is the best way that I could summarize the story of what happened today. You had a good jobs report yesterday that caused the market to start out good, and then it flipped and went bad and tried to climb back up and finished awfully flat yesterday. But the good start to the market yesterday disappeared because people started getting worried about interest rates and about no interest rate cut from Jerome Powell. I don't know why anyone between now and the Fed meeting in June, because in May the change will take place. I will be gone. Kevin Warsh, if he's confirmed, which I think Democrats will do everything they can to keep him from getting confirmed, but I think the Senate will confirm him. He's going to be in place for the meeting that takes place June 17th. These next two meetings, March and April, why anyone would think there's going to be a rate cut no matter what data comes out? Why anyone would be surprised that there's not a rate cut no matter what data comes out? Anyone who believes that Jerome Powell is going to make a cut in one of these two meetings for no other reason than Jerome Powell knows that Donald Trump would like him to cut rates. That reason alone, data be damned. He is not going to pay attention to or care about the data, and Jerome Powell is going to not interest rates in either of these next two meetings. So, really good jobs data. The story becomes, well, that probably lessens the chances of a rate cut. I don't know how you can get less than 0% chance that there's going to be a rate cut. The media perpetuated it. People sucked into it. It caused the market to sell off yesterday. Ended up climbing back and finishing break even. Today, similar start to the market. You had everything start out to the high side. The S&P took off to the upside. The Dow, the NASDAQ, they all took off to the upside. Not huge, not gigantic gains, but they all took off to the upside. And the jobs numbers that came out that had to do with unemployment claims. The unemployment claims, again, they show possibly a slightly stronger job market than what was expected. And it looked like the market was going to shrug that off. Remember, that's a pre-market report. It looked like the market was going to shrug that off. And then about an hour and a half into the trading session, this other report came out. This housing report came out. Let me pull it up here. There was a housing report. Was it this existing home sales? It was, yeah, they were expecting month over month The expectation was the consensus would be, well, that's on the rate. The previous month was 4.4. I guess there wasn't a consensus was expected, but it was a drop of 8.4. This became the headline. This became the news. And it got tied in very quickly to this AI disruption fears. I have gone on and on a couple of these podcasts, this AI story, and specifically, not just the AI story, specifically the lack of knowledge that most market analysts, most brokers, most hedge fund managers, most mutual fund managers, most registered investment advisors, most large money managers, the people that control the most amount of money in the stock market, don't have a clue. I'm not sitting here telling you that I do. I don't know enough about AI to know one way or the other, but a lot of these money managers that don't have a clue are getting so spooked by the media narrative around AI. It's not, I don't think there is a flaw in the AI spending model of big tech companies. I don't think there is a legitimate concern about AI replacing more jobs than it will create. Remember, if you've been in the market long enough, or if you've been post high school or college long enough, you remember the dot com bubble that took place in the 90s. We had a roaring economy through a good portion of the 90s, and any new company that had the name dot com put on the end of it seemed to just take off. The stock, I mean, some of these companies were absolutely worthless. Stock took off, built up this big dot com bubble, and then it burst right at the end of the decade, 99, 2000. There was this big bubble burst. A lot of people lost a lot of money in that. A lot of people got burned by that. And there is this assumption by many that have been around since that AI is going to do the same thing. Forget about the fact that the internet has created far more jobs than it ever took the place of. Forget about the fact that every single year, every single decade, advances in technology do more to enhance worker productivity and create jobs more so than the jobs they displace. They do, in fact, displace jobs. They when technology advances, it sometimes takes the place of jobs. Um, it's going to happen, but it will create more jobs that will take the place of. It seems like everyone that's in charge of money right now has completely forgotten that. There's all this concern about AI is going to take away too many jobs. 2 weeks ago, it was with software. AI is going to write software. We won't need any more software coders. There won't be any need for software companies because AI is going to do it all. No, it's not. No, it's not. You think that the media people creating those headlines are smarter than the minds at Microsoft and Amazon and Alphabet and Meta? Do you really think the people that are in the media and the people that are market analysts and even the people who are managing money, do you really think they are smarter than the top minds, Palantir and CoreWeave and some of these other companies that have been really hot and really volatile for the last year and a half? I just don't see it that way. I think AI is going to do nothing but improve lives, increase productivity. It is going to displace some jobs, but it's also going to create a lot more jobs. You get a headline, and the media, the financial media, to me, they're the biggest culprit. They just perpetuate these fears with these headlines like this. It's like they're the ones running around saying the sky is falling, the sky is falling, and they don't have a clue what's going on. They really don't. So when the news broke about the housing stuff, it immediately got blamed AI. And the AI story ties into the interest rate story. The reason I mentioned Powell and I mentioned the Fed is that there's concern that these companies that are spending money on AI, they're borrowing so much of that money that they're spending, and they're borrowing it at higher interest rates. And if interest rates don't come down, it's going to bankrupt these companies, and everyone should sell all of their stock, and we should all go bury our head in the sand and let the first the stock market, then the U.S. economy, then the global economy is going to crash because we're getting smarter and we're finding more ways to do more innovative things. That's a good reason to go bury your head in the sand and light a match just before you do and let the entire global economy burn to the ground. And you tell I'm upset by this. I know I'm coming off. It's so annoying to me that there are so many people that buy into this. I'll give you a great example. And believe me, we got out of this trade yesterday. This did not negatively impact us. But here's a perfect example. Look at this sell off on Apple today. This is a great example. There is no logic behind that sale. That sell off on Apple today is a fear driven, fear motivated sell off because of financial media headlines by people whose heads are in the sand or up their rear ends. I don't know which. I want to say the latter, but that's really crass and really crude. But that's what caused this sell-off today. And then the lemmings, who are the money managers that don't know any more about AI than the financial media and the financial analysts that are making the headlines and driving the headlines, the actual people controlling your money don't know any more about it than they do, and they're just lemmings that just follow suit. So that's why you get the sell-off you had today. It hit a lot of companies on a very, very, I'm going to shift gears, like turn on a dime right here, on a very happy, very positive note. It was fantastic for our portfolio, with the only exception being that Amazon and Nvidia got hit, and these numbers are a little bit worse than they were the other day. Walmart number is way improved, and we're still doing plus 37% in our open spread trades. In our triple play trades, I could not be more thrilled because we took an early exit on coin, got out at 12.5% on that. We got out of Cisco, our second Cisco trade, in a very, very short period of time. We got out with 23, almost 24% because Cisco tanked this morning after their earnings. And then we got our Robin Hood trade that just a couple of days ago was looking really iffy. Yesterday was looking really iffy. And pre-market trading this morning was looking really iffy. And then all of a sudden it started to go down and we were able to get that easy exit. Now, would have, could have, should have. I wish I would have stayed in Robin Hood. I wish I would have been in there. They finished well below today where we needed them to be to guarantee us like maximum possible profit in the trade. Even if they bounce back a little bit tomorrow morning, I don't think it'll be a big bounce back. I don't think they're going to skyrocket above 76. If we'd have stayed in until the end of the day or stayed in until tomorrow morning, chances are we'd be 15, 20, 25%. But you know what? I didn't want to take that chance. And I didn't know they would fall as far as they did today. I'm ecstatic because I got out with 11% on a trade that yesterday was down almost 50%. And look at where we're at for our triple play trades so far this year. Almost 41%. I'm absolutely ecstatic. And probably tomorrow morning going to add a trade or two, one or two more trades to the triple play portfolio. So watch for that on Discord tomorrow morning. Okay, last thing, Intel. Before the big sell-off, I'll show you the chart on Intel because it's a similar story. Absolutely unequivocally no reason for it to have the sell-off today, although it didn't have as big a sell-off and it was starting to tip a little, go that direction. But they finished today below the strike price of our short put. If you haven't already had it happen, you're probably going to have Intel stock put to you the open tomorrow because we've got 47.50 short puts. This is for our call. In a preemptive move, and this is why we sometimes use bull put spreads to get into collar trades. We closed our long put that expires tomorrow. We rolled it out a little over a month. left it at the same strike price, and we did this in anticipation of having stock put to us at 47.50. The credit that we took in right here, this $1.80, when the stock is put to us, 100% of that will be ours. This will change to a zero. Then we will add shares, and that shows profit. We will add shares at the 47.50. They'll be worth less than what we got them for, but that's why we took in that big credit. We'll have them protected and we'll be in good shape. If somehow, some way Intel rebounds tomorrow, and we've already got this long put sitting out there in March, we will just, if it rebounds, we'll add a 47.50 short put for the end of next week or the end of the week after that. And then we'll add another one if that one expires. And if we go all the way up to the 20th of March, we will have credit from one or two or maybe three more additional short puts, any of which could have stock put to us if the stock turns and goes bearish. So this is the exact way we use a bull put spread to get into a new collar trade. I did this before the market closed, so my long puts are now out in March. If stock gets put to me at the open tomorrow, no problem. As soon as stock is put to me, I'll add short calls. If there is a rebound tomorrow and stock is not put to me and my 47.50 short put expires worthless, I'm not going to have short calls in place to have to worry about. They would be naked calls. They technically would be naked if I added them right now. Won't add short calls until the stock is put to me. So super easy way to get into a good collar trade. And the move down today doesn't bother me. I'm set up Intel with the intent of getting into another collar trade. So it will be on Discord tomorrow morning. I will be active on it throughout the morning and do a regular podcast tomorrow at the end of the day. Thanks, everybody. Have a great rest of your Thursday, and we'll see you back here tomorrow.